York Stock Exchange, Smurfit Westrock ringing the opening bell. Tony Smurfit, the CEO, is going to join us in just a moment after changing his listing from London to New York. So we got an Irishman here in New York. On the NASDAQ, we saw the U.S. soccer team ringing the bell, at least a couple players there. In terms of the futures, they are higher on the S&P right now, just about 0.1%, but every little helps. NASDAQ futures unchanged right now, and Russell 2000 futures really off to the races, up almost 1% on the small caps. Let's get over to Katie right now with some of the stocks to watch. Katie?
Well, one stock to watch at the opening bell, we have Morphic. Eli Lilly agreeing to buy the U.S. gut drug maker Morphic for about $3.2 billion. Of course, this is a core area for Eli Lilly. The CEO, Dave Ricks, he's promised more early stage deals to acquire new technologies. You look at how it's playing out, of course, in the first few seconds of trading. You can see Morphic up about 75%. And Eli Lilly, even though you typically see the acquirer fall, it's holding in there, up about 0.2% right now, Shonali.
I'm also keeping an eye, Katie, on Tesla because the EV maker is poised to snap an 8-session winning streak. Remember, just on Friday, you saw Tesla slip into green territory finally for the year, but you're seeing it down now about 1.4% on the day. Let's see if it holds, Matt.
All right, and Paramount, it's the end of the Redstone era as the media giant inks a deal with Skydance Media. It ends one of the messiest and most dramatic deals in recent history. For a closer look at Paramount, let's go over to Bloomberg's Abigail Doolittle. Abby, what do you got?
It really is pretty amazing. Deal on, deal off, and now the deal is official. But on this, we actually have the shares of Paramount at this point down about 1%. But this, of course, follows months of very complicated deal making because David Ellison's Skydance has agreed to buy Paramount. They've been trying to do that for a while. So I should actually say Sherry Redstone has agreed to sell her family's National Amusements, which has a controlling stake in the shares of Paramount, really holding up that $8 billion deal. In fact, if we take a look at the voting picture for the Paramount shares, just that little sliver there, that orange sliver, that controls, so about 600 billion controls, 600 million of the stock voting shares, controls all of Paramount. She agreed to sell it for $2.4 billion. And now that they have agreed, David Ellison and a partner have agreed to buy Paramount, or National Amusements, I should say, that has this controlling stake in Paramount for $8 billion. There's hope that maybe MTV and CBS will be regenerated. But not everybody is surprised by this, Matt, because, again, it has been months of deal on, deal off, various deals. In fact, if we take a look at the stock over the last 12 days, we will see that even though the deal between David Ellison and Sherry Redstone broke down a few weeks ago, the stock up sharply over this time period, suggesting, well, some people not so surprised today. That could be, Katie, why the stock is down just a little bit today.
All right, Abigail Doolittle, thank you so much for that wrap up. And let's broaden out the conversation now to the wider stock market, because joining us now, I'm pleased to say, we have Maria Waitman. She is head of equity research over at State Street Global Markets. And we were talking to Mike Wilson just a couple of minutes ago, and he told us that he wouldn't be surprised to see a 10% correction to the downside between now and, of course, the November elections. Does that seem plausible by your math?
First of all, hello. Very good to be on the program. I would not be surprised to see some decline in S&P X technology. So that's where we're seeing weakness. That's where earnings are slowing. That's where kind of all the Fed and other central banks' effort to tighten policy are bearing fruit. However, we are still very, very optimistic about technology sector. We see earnings being strong. We see margins being resilient, and that's really giving the strength to the market. And one lesson we learned last year was that if tech is going up, the whole market is going up. So I think S&P X Tech, lots of concern for the whole market. Tech sector is going to support it.
Are these tech companies, Maria, these, Magnificent Seven, are they defensive stocks? Does it matter to them what the Fed does with rates? Does it matter to them if all the economic surprises come to the downside?
Yeah, and I think that's a really, really good point. And I think that's what AI has done for technology sector, AI excitement done for technology sector. We continue to see quite a strong revenue growth in technology sector because companies outside tech are really trying to figure out how to benefit, how to make money in with AI, and there are still continued investment in that theme. We're yet to see where the money ends. Is it software? Is it hardware? Is it chips? Is it something else? But money coming from outside tech into tech, and that's supporting the sector overall.
If we look at the concentration, like the breadth, Maria, that we've seen in this market, every time we have a big rally, we sometimes see only 150 or even fewer companies rising. Does that worry you that the breadth is so light?
I think it would worry me if there was just breadth in performance, but like lack of breadth in performance. But what we see, there is lack of breadth in earnings as well. So those technology companies are pretty much the only place where we see strong earnings growth, resilient margins. So what is happening in the market and actually quite sensible. So investors are going for sectors, for stocks with better underlying fundamentals, which makes a lot of sense if you think that overall economic growth is slowing. So you should go into those quality companies.
But you like then individual stocks and you don't have a bullish view on the broader market?
But I think that's the trick, because those companies we like in technology sectors, they are really so big. So they probably going to pull the whole market kind of with them, pull them higher. But I would very much, I would not at all expect the kind of the rally broadening to like small caps or value or cyclicals. That's not what we're saying. We're saying tech is strong. It will continue to be strong. There is momentum behind it, and it will pull the whole market.
Even if you believe that it could pull the market forward, do you get concerned, Maria, about valuations here? You think about just NVIDIA alone, finally getting some dispersion from the analyst community here. New Street Research with a downgrade, still they're an outlier. They're back on the rebound today after you saw UBS upgrade. Where do you stand in the valuation story?
I mean, no doubt that technology stocks are expensive. Or, well, they're trading at a premium to kind of historical multiples. But I think what matters at the current stage of the cycle, when earnings overall are slowing, economy is kind of getting weaker, and we can debate soft, hard landing, but it's getting weaker. You have to go and buy quality. You have to go and buy a better earnings story, more resilient margins. And oftentimes it's an expense of higher valuation. And that's what investors are doing. Investors do have large position in tech, and we see them adding to them.
And really quickly, before we let you go, I mean, you talk about the fundamentals here, and you think about the fact that we're skating into another earnings season. What's the most important metric that you're keeping an eye on? It seems like valuations maybe not the thing to look at, but for example, I've heard more of an increasing focus on cash flows, for example.
I mean, cash flow is super, super important. And again, tech is by far in a way the best performing sector. I'm very curious to look at corporate guidance. So we know that consensus expectations are for reacceleration of earnings growth in the second half of the year. And so far we heard from a few companies like Nike, FedEx. None of them are actually that optimistic. So to me, that would be interesting to see whether this consensus of reacceleration earnings growth in the second half can hold. And I'm a bit skeptical there.
Maria, great to get some time with you. Thanks so much for joining us on opening day. Maria Waitman there, head of equity research over at State Street Global Markets. Coming up, we're going to speak to one of the leaders behind the world's largest hedge fund. Greg Jensen, co-CIO at Bridgewater Associates, joins us. We're going to talk to him obviously about markets, also about politics, but especially about AI, artificial intelligence, and machine learning. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
All right, let's get to our top calls. Some of the analyst action in focus this morning. And first up, we have UBS raising its price target on NVIDIA to $150 and keeping a buy rating on the shares. Now, the analyst cites robust demand for its AI chips, and that follows on Friday a rare downgrade for the chip maker by New Street on valuation concerns. Next up, we have Raymond James upgrading Gilead Sciences to outperform thanks to potential growth in its HIV and liver disease treatments. And finally, we have Guggenheim cutting ServiceNow to a sell. The analyst says that the software company's valuation doesn't match its future risk, Shanali.
And we're going to switch gears. We're going to talk about Bridgewater. The world's largest hedge fund is on the rebound. The Pure Alpha strategy, very highly watched, is up 18% through June after a weak 2023. That's all according to people familiar with the matter. Bridgewater is also plowing into the high-flying world of artificial intelligence. Joining us now to talk about it more is Greg Jensen, the co-chief investment officer at Bridgewater Associates. And Greg, talking about, the performance at Bridgewater has clearly been up double digits this year. What is happening that's going right? What are the bets that you guys made off that you are seeing now play into 2024?
Well, I think Bridgewater can benefit in multiple ways. The basic idea of Pure Alpha is that for over 40 years, we've built up our understanding of how macro developments impact markets. And we continue to improve that process, but there's been so many things, as you guys are talking about here, so many major macro events going on this year that have pressured markets. The fact that the Fed had to tighten slower than it expected to at the beginning of the year, the ripple that had through the fact that U.S. growth has been generally resilient, all of those pressures add up to opportunities for us, and particularly differential pressures across countries. After the tightening cycle was very global, the impact of that tightening cycle across the world has been quite different, creating a tremendous amount of opportunities for a strategy like Pure Alpha.
What do you expect going forward? I was watching last night in preparation a panel you did at Davos, which was back in January. You were skeptical that we'd get 6 cuts this year, and at that time, the market was pricing that in. Now, we're only looking at 2, maybe 1, and yet the market is up, 15%. What's driving that, and can it continue going forward?
Yeah, well, when you talk about the equity market, I think the biggest question, right, the thing that reconciles the circle between the interest rate market and the equity market is productivity. Is there going to be a major productivity effect of the new technologies, machine learning, et cetera, coming through? Because you need it, really, to reconcile the level of the stock market. The expectation for earnings going forward are quite high. At the same time, the expectation, the interest rate market, is that the central bank will be able to cut rates, that services inflation will continue to come down. So you need this kind of perfect situation of earnings staying strong, demand staying strong enough to make those earnings strong without keeping inflation above the Fed's target. How do you get there? You've got to get there through higher productivity. So that's the big question, is how much productivity, when will it occur? Because to reconcile the markets, you need a pretty big jump in productivity to allow higher earnings and lower inflation.
Well, I definitely want to get to machine learning, but before we do that, let's wrap in Fed risk and political risk into one question, because I was reading a note from Goldman saying that the risk of Trump being reelected and putting in place some of those tariffs that he's talked about, it could lead to 5 extra Fed hikes. So not talking about cuts there. And when you think about all the known unknowns that are out there, especially as it relates to politics right now, are you hedging for any risk of something like that scenario playing out?
Yeah, I think you have to be really thoughtful because there's so much political risk going on. And the shift generally you're seeing across the world is kind of dissatisfaction with the people in power, populism in many cases continuing to be on the rise. And a Trump versus Biden or Trump versus whoever the Democratic nominee ends up being is very significant change in policy. One of the more significant elections. It'll probably happen very quickly, just like there was the significant corporate tax cut when Trump came in before. He's coming in ready with tariffs. That's the big first thing. The second thing will be the continuation of the tax cuts. All of this move towards populism is pointing towards a continuation of more government deficits, probably more inflation, tariffs, at least in the short run and probably in the long run. Our view would be that they're inflationary. And a Trump presidency, the thing that we'd kind of most be concerned about is the long end of the rate curve, probably bond yields. Fed, they'll try to get an easy Fed in and probably have the most significant challenges on the long end of the yield curve in terms of bonds. But those policy changes are going to be significant. And if you look at basically just understanding global macroeconomics today versus 25 years ago, understanding government interaction with markets has become so critical.
How do you then position, if you believe inflation is in the future, do you go short the long end of the curve, and do you do it significantly?
Well, we try to take a diversified set of positions so that no one position can be too dominant in our portfolio. But it's tricky, right? The long end of the yield curve, a lot's going to depend on politics, right? And a lot's going to depend on how unified the government is. Will Trump be able to get everything he wants, or if the Democrats are elected, will they be able to get everything they want? Divided government will generally be good for bonds, and a unified government, one way or the other, Republican or Democrat, would probably be bad. Anytime these governments are unified right now, you're seeing movements towards populism, movements toward bigger deficit spending. And we think that's the more likely outcome, is that you continue down that path. But there's a lot of change along the way. And in the short run, what's going to matter is Fed policy. And is the Fed constrained? We think the Fed's itching to ease. They want to essentially have the stats come in a way that allows them to, and we're close to that. They probably
need to, right? With $100 billion plus of debt servicing costs every month, we need rates to be lower. At what point does, and I know we want to get to AI and machine learning, I want to get there as well, but at what point does this massive debt and the servicing costs really start to become a problem for, the 10-year yield or the strength of the dollar?
Well, and that's what I think we're going to find out, right? What you can see right now is there's not much risk premium in long-duration bonds. There hasn't been a problem. That doesn't mean there won't be, right? And I think the main thing I'd say is the destiny here is that governments are going to push until we hit the limits, right? You see that in countries like Brazil or whatever, where they're at the point where fiscal spending hits the limits. You saw that for a brief moment in 2022 with the UK.
The Liz Truss moment.
Yeah, Liz Truss moment. But in the U.S., you're still probably a ways away. But I think the destiny of it, because of the populism and sort of the amount of things that need to be fixed in the U.S., the likelihood is we find that. Now, I would guess that's a couple years away, but that we'll continue to press in the direction until we find the limit, that easing fiscally will continue to be the path until that limit is hit.
Until the bond vigilantes come back.
Yeah, and it won't be, speculators are too small relative to what's going on. It's really the Fed and and generally the size of that issuance. And so what is going to be the limit is inflation. If there's no inflation problem, there won't be a problem for bonds. It won't come from anything other than inflation currency problem.
I want to talk about something people are really excited about. That's artificial intelligence. Greg, we recently reported that just about a week ago, exactly a week ago, Bridgewater started its own AI strategy in a new format here, in a new fund format. But also, you were an early investor in OpenAI, in Anthropic. How do you think about investing in AI at Bridgewater? Do you buy into those high-flying names, or are you better off doing it in the private names personally, given where valuations are today?
Yeah, well, I'd say when we think about it from a pure alpha perspective, most of what we built up at Bridgewater is an expert system based on everything we've learned over the 40 years, mainly on how economic cycles work. And big productivity miracles are pretty separate from economic cycles. So when you look at what we're doing in pure alpha, we're generally trying to make sure we don't have too much exposure to whether the productivity miracle works out or not. So when we trade U.S. equities, we trade them kind of with AI hedged, because the pressures, the normal cyclical pressures will play out on the regular companies. And when you look at U.S. stocks, it's kind of the regular companies that we'd say are pretty expensive relative to the rest of the world. Mediocre companies in the U.S. have a U.S. premium in them relative to the rest of the world. Now, the great companies in the U.S. are the companies hitting the cutting edge. That's a different story. And it's very different than 1999, 2000. I've been at Bridgewater for 29 years and having lived through 99, 2000. That bubble was all about future expectations. Most of what's priced into equities today actually would say are based on what's happening right now. I mean, what's happening with NVIDIA's demand is incredible. And whether it's slightly overpriced or slightly underpriced or whatever, it's a close call. This is not like the 99 bubble, at least in my view, because the earnings for those companies are actually there in a way they weren't there for a company like Cisco in 1999. So there is a big difference. Now, you still need those earnings to be sustainable, which requires a continued growth in those areas, but not an outlandish one. And that really comes to what internally. So we need to understand AI from a macro perspective, and then we need to understand it from as a user, a micro perspective, right? That in our IA labs, which is 25 people we set aside at Bridgewater, fully focused on using machine learning for everything you need to do to invest in markets, that group, we're hands-on. We see both the problems. There are many problems. The language models off the shelf have many problems with them. But if you can combine them with data models, you can create this incredible strength. And right now, I expect over the next 5 years, so much of what human investors and analysts can do can be better done with machine intelligence. And that's been a journey for me. I've been looking at this for, Bridgewater's built an expert system based on human intuition being translated into algorithms.
Right.
For AI, having machine learning generate the ideas, generate the algorithms. That's been kind of a dream for me. And the technologies really came together in 2022 or so, that the pieces came together such that I thought we were ready to build an artificial investor. And we've moved down that track at rapid rate.
Greg, thank you so much for giving us a preview on this new strategy over at Bridgewater. And of course, the view of a very complicated markets. Of course, that is Greg Jensen, CIO at Bridgewater Associates, co-CIO. Now, coming up next, the market moving events you need to be watching this week. There are a lot of them. That's next in our trading diary, coming up next. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Let's get to the trading diary, what you need to be watching this week. We get the New York Fed inflation expectations at 11 a.m. today. Powell will deliver his semi-annual testimony on Capitol Hill starting tomorrow and go further with that on Wednesday. On Thursday, we get CPI, so more inflation data. And then on Friday, JP Morgan, Wells Fargo, and Citi will kick off earnings season. We're here to cover it all for you. Coming up in the next hour, investment guru Howard Marks of Oaktree Capital. And in today's C-Suite Conversations, Anthony Smurfett, the CEO of Smurfett Westrock, joins us, one of the world's largest packaging companies, plus the CEO of Lambo. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Emerging technologies are driving global sustainability progress.
95% of investors believe that these technologies will be pivotal to achieving a more sustainable world by 2030. And AI is at the vanguard of these emerging innovations, with global VCs believing that investing in AI will accelerate sustainable development in the years ahead. Learn more about Bloomberg's Future Technology Study, sponsored by Mubadala.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are also streaming live, that video thing, on YouTube. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Coming up, we're going to start off the show strong. We had a sense of what's going on with the equity markets with Abigail Doolittle. She'll be in studio giving us the latest on the markets. And then we're going to join Bloomberg Television, a simulcast. Bloomberg's Shonali Bassick, Katie Greifeld, and Matt Miller. They are speaking with Oaktree Capital co-founder Howard Marks. So we'll bring that to you. Shelby McFadden's going to join us, investment analyst of Motley Fool Asset Management, to get her thoughts on these markets. And then Sean O'Hara, Pacer ETFs. I want to know where the money's going. Is it still going to that spot Bitcoin ETFs? Where's the smart ETF money going with the latest there? But first, let's kick everything off with our good friend John Tucker.
All right, Paul and Alex, last week we saw the best week of gains for the S&P 500 since April, and we're building on that this morning, adding to the records that we set on Friday. The S&P 500, 8 of the 11 major industry groups are marching higher, and we also have a record right now for the NASDAQ as well. But Sam Stovall at CFRA among those worried about the lack of market breadth and also the high valuations. Right now, the S&P 500 is 10 points higher. That's up 0.2% at 55.77. The Dow Jones Industrial Average is up 242 points. That's a rise of 0.6%, 39,617. And the Nasdaq 100, that has just turned lower, down 2 points. As far as treasuries, the 2-year yield up 1 basis point. That is at 461, and the 10-year, that was unchanged at 427. We've been saying this all morning, busy week. You have Jerome Powell. He's going to start to deliver the, what do we call it? We used to call it the Humphrey Hawkins testimony, the semi-annual testimony to Congress. That starts tomorrow, wraps up Wednesday, Thursday, CPI, and that's followed by the PPI, and of course earnings kick off this week, Thursday, and then we get the major banks on Friday. So a lot to chew on for investors this week. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. I have to wonder this week, is it going to be the economic data / Powell? Right. Is it going to be just how do we hedge any election risk, or is it going to be those earnings? Like, what's going to actually be the mover?
There's a lot, and President Biden out today with another statement saying, I'm not going anywhere.
A statement? He was on MSNBC. He called in. I mean, that was the debate that people wanted him to actually have. Granted,
so
he had it over
guess
the phone.
That's
but
how that's going to play out.
And how did he fare while talking to MSNBC?
I mean, being a seasoned political analyst that I am.
Well, did he stumble?
Not
was
at all. He was on fire. He was cogent. He did exactly what he should have done. He made like very short sentences, lots of passion, and just trash President Trump. Like that's what I think everyone was looking for him to do during the debate. He took responsibility for his debate actions, but he was also calling into MSNBC.
Right,
like he's not calling into Fox News. You know what I mean?
I'm not a trained journalist, unlike everybody else in this room here, but when the New York Times went negative on Biden, from an editorial perspective, the next day their reporting coverage shifted. The next day. They started highlighting all the negatives and all the stuff all the problems. And I was like, wow, really?
As in just that the high-up editorial drives so much of the reporting, you mean?
I guess, but man, that was not a good look from my perspective. But there
anyway,
you go.
It was a very interesting phone-in,
Okay,
very much like President Trump did with Fox. All right, let's get some market movers here on this record high day when there's not that much happening. That sums it up for you. Abigail Doolittle is joining us. Paramount, though, that's a something.
It is a something, and
finally,
it's interesting because stock investors are sort of giving it wah, wah. It's down 4% now after a deal has finally been announced that Sherry Redstone has agreed to sell National Amusements, which owns basically has an 80% controlling voting stake of Paramount, to David Ellison's Skydance, and they are buying it. David Ellison, Skydance, and his partner, capital partner, I think Redbird Partner Capital, for $8 billion. So, there's been just so many deals through the last couple of months, but even over the last couple of years for different pieces of this company. The stock, interestingly, up about 10% or more from its 1990 IPO, but down more than 85% from its 2021 peak. So
that's it for the Redstone family.
It is. It's kind of amazing.
Disappear.
After 40 years, her father and her, this, entertainment mogul family, CBS back in the heyday, MTV, and yes, gone.
CBS. I mean, in my 20 years covering the media industry from a banking perspective, I probably pitched Paramount or National Amusement Stake no less than 20 times.
Really? And how many years ago was that? So this has just been an ongoing...
No, that's what you do. You make pitch books and you get on the road and you go. I wouldn't even have picked up the phone to call anybody in this group. I just wouldn't have done it.
It just doesn't make sense to you.
None of them are credible. None of them are real, and that's why the stock's trading down. If I'm a Paramount shareholder, what's this guy
So
bringing
you think
to the
that they're
table?
not going to be able to turn it around? This is going to be more of the same.
Do you know what a producer of a movie is? Nothing. They just write the money and make sure that their director's hired, the script's there, and this,
So he's going to need to hire a good person to take over.
See. But that's why the stock's down.
Let's see what happens.
Wah, as you said, wah. Okay, what else we got?
So right now, as John Tucker...
The next story I like.
What's that?
I like your Lilly story. That's interesting.
Yeah, Eli Lilly is interesting, and we have, let's see at this point, Morphic, let's see how much it is up. Last time I looked, it was up 76%. So Eli Lilly is buying, 75% is buying Morphic for for $3.2 billion in cash. It's essentially for one of their IBD drug, calling it a gut drug. It's a good outcome. Many analysts are saying investors loving it. Again, up 75% on the one day. And just to take a quick look at Morphic's market cap, $2.8 billion. So it's small, but still it's not as though it was, tiny.
Yeah, really interesting stuff. Abigail, we're going to leave it there. Thank you so very much. There's other stuff that we're watching for sure. Today, we're looking forward to earnings that are going to be kicking off later in the week, right? John Tucker was talking about CPI on Thursday, 2 days of Powell. I mean, there's a lot to kind of get through at the end of the day. And even the sector spin are quite interesting as well today. All right, let's get to Howard Marks. Oaktree Capital co-founder, interviewed by Katie Greifeld, Matt Miller, Shanali Bassick. Let's check in right now.
In our Bloomberg television and radio audiences because, of course, as we've been talking about, that mounting concern about how big government spending has going to create this issue here to markets, potentially upending them, making the job more challenging for central banks. Of course, as Jerome Powell, the Fed chair, has 2 days of testimony ahead in Congress, all in the middle of a weakening labor market here in the United States. It's the perfect storm. We are now joined by Oaktree Capital Management co-founder and co-chairman Howard Marks to talk all about it. We've been talking about the fiscal issues, right? We've been talking about the monetary conundrum that's been happening for now well over a year for the Fed chair. If you think about the potential for fiscal to really upend how investors think these days, how much is the government debt loads in the U.S. and abroad really changing the calculus?
Well, look, Sonali, I think it's unfortunate that the U.S. behaves like a country that has a credit card with no credit limit where the bill never comes. I mean, nobody can think that's a good idea. You would think that there has to be a point at which our debt or our deficits become too much, reckoned as a percentage of GDP, usually. Nobody will tell you that point doesn't exist. Nobody will tell you where it is. Nobody's exercising fiscal discipline in Washington these days. Last year we had a deficit in the trillions in a period of prosperity. Not supposed to happen. All very unfortunate, but A, nobody can tell you when it becomes a problem, and B, nobody can tell you what to do about it. You can't eliminate the U.S. from your portfolios. People who've said to do that in past years are now looking pretty bad.
Yeah, I was going to say, if you had followed that advice, you'd be in a world of hurt right now in terms of relative performance. And you said that no one can tell you where that point is, but that's exactly what I'm going to ask you. Where do you think that point is? Is it something that we're approaching if you don't want to exactly pinpoint it?
I don't want to exactly pinpoint it. I want to say that I'm among the people who can't tell you where it is. You
Fair
know,
enough.
One of the many.
Yeah, you know, I think every time I come on this on Bloomberg, I quote Mark Twain, who said, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true." I certainly don't know.
I wonder what kind of opportunities you're finding. I'm always interested on the distress side about how sort of target-rich the environment is. I think that says a lot about our economy. All the economic surprises that we see are to the downside lately, and rates remain high. Does that make this interesting for you?
Well, I think it is interesting. I mean, we went through a really slow period from 2009, when the Fed took the Fed funds rate to 0 to stimulate the economy, to 21, when they decided to lift it to fight inflation. And in that 13-year period, there was very little distress because it was a very benign environment for companies. Now, as you note, interest rates are higher. That gives us more of an opportunity. And importantly, there were a lot of leveraged transactions done in the period I described, where companies were burdened with capital structures, debt structures, that did not anticipate a 500 basis point or 400 basis point increase in rates. So, you know, to put it in short, it was a great time to be a borrower because rates came down and business was prosperous. But right now, and I think going into the future, leveraged companies will not be able to renew their leverage as easily, and the cost of doing so will be higher. So that gives us better opportunities than we've been seeing. And you know, just to put it in brief for your listeners, 6 years ago you had an idea, you went into the bank, you described it, they said, fine, we'll give you $900 million at 5%. Now it's time to renew your debt. You go in, you describe it again, and they say, good, we'll give you $500 million at 9%. Yeah.
Where do you think most of that pain is going to come? Because there's the private equity universe that's clearly grappling with that refinancing pain. There's the commercial real estate market. And equity investors seem to be ignoring any leverage that might be under the system still. What should they be watching out for?
Well, clearly, it'll be in highly levered situations, and you named two of them, private equity and real estate. Leverage, the use of debt to amplify your returns, it has been the lifeblood of these two asset classes, and they've done extremely well as a result. It was very, very salutary for them, but that's where the pain will come in the future. You know, you can't increase a company's debt service cost markedly without affecting its returns. And in certain sectors of the real estate world, mainly retail and office, there are fundamental questions. So you put that together, we think you'll see some disruption, which will give us and people like us opportunity. You know, this has been a really tough period for lenders, which is what we are, and a really tough period for bargain hunters.
Right. Well, I want to talk a bit more about the business of lending and what's going on in the private credit industry. Of course, a month or two ago, we saw Pluralsight, backed by Vista, basically transfer its assets into a different subsidiary to obtain more financing from its sponsor. That's become a little bit of a battle cry. You see lenders basically asking for Pluralsight protection right now. I won't ask you specifically about what happened with that episode, but how do you see this evolving in the industry? Do you think that we're going to see more creditor-on-creditor violence, as some have been calling it?
Well, you know, people tend to do what they can to enhance their position financially. Most people will stick to what they can do legally. Some people will stick to what they can do ethically. There's some question about what that means. But you know, people, if there's an opening, people will take it for the most part. And there is an opening for what you call creditor-on-creditor violence. That is proactive proactive efforts to enhance your situation financially at the expense of somebody else. And so the important point is that it's up to lenders to study the documentation well enough to prevent it. That's it.
Are you active in office space right now? Because it seems like the perfect storm for anybody who has the financing. We talked to Igal Namdar, a real estate investor, a couple of days ago who is getting like 70% off really big, important office buildings in New York, the capital of the world. Like, how can that not come back?
Well, the question, Matt, is very simple. Let's say you're getting 70 off. Is that enough? And, the mere fact that the price of something is down doesn't make it a buy. It has to be that the price is down more than it should be given the fundamentals. And, I think it's going to be up to the experts, people who've made their life in that world and with success, to make that assessment. I think that if there is a bunch of real estate funds formed this year, somebody who puts all their money into office and somebody who puts none of their money into office, one of them will be the best performer. I just don't know which one.
If you have these struggles that are still under the surface, we are just about, 5 days away, really, from bank earnings. And the question is we enter this era where they're about to meet new capital rules as well. Mm-hmm. Are there still just tremendous stresses under the system that people are not noticing?
Well, it's the small to mid-sized banks, the community and regional banks that are heavily weighted toward real estate loans. The biggest banks, over $250 billion in assets, don't have much of a concentration. They're not at risk. But some of the smaller banks, I think on average the banks under $250 billion in assets, loans on real estate make up 160% of their regulatory capital. So some of them will find pain, especially the ones who lent above average and concentrated in regions that are troubled and so forth. So, I don't think it's a systemic risk that's going to put us in the sink, but I do think that you'll see some companies in trouble. And, one by one, the authorities may have to bail them out and may well do so.
All right, Howard, unfortunately, we have to leave it there. Great to have you, of course, on our launch day. Our big thanks, of course, to Howard Marks. He is the co-founder and co-chairman of Oaktree Capital.
You've been listening to Howard Marks, Oaktree Capital co-founder, along with Shelley Bassett, Katie Greifeld, and Matt Miller. They launched their new show today, Open Interest, that airs from 9 to 11. A great lineup of guests. They're also going to drill down to some company stories and CEOs and really get the beat on the markets there. We got the beat on the markets for you, but for that, we go to John Tucker. John?
All right, records on NASDAQ, S&P 500 adding to last week records. So if the S&P 500 finishes the day higher, it's going to be the 35th record this year. Then, of course, a big week. Earnings season starts this week. Analyst upgrades to profit estimates have outnumbered downgrades going into the second quarter reporting season. In addition to that, you have the Fed Chair, Jerome Powell. He begins the Humphrey Hawkins testimony, what we used to call Humphrey Hawkins. Begins tomorrow. That'll wrap up on Wednesday. And then, inflation data this week as well, with the CPI followed by the PPI. Meantime, Sam Stovall at CFRA, among those worried about the lack of market breadth and the high stock valuations.
We do need to experience a resetting of the dials for me to feel that this bull market is not at risk. And who knows how long this will continue until we do get that reset.
The S&P 500 right now 10 points higher. That's up 0.2% at 55.77. The Dow Jones Industrial Average is up 181 points. That's a rise of 0.5%. We're at 39,556. And the NASDAQ right now, that's up 28 points. That's up 0.2%. 18,378. And as far as treasuries, the 2-year yield, which is more policy reactive, up 1 basis point. That is at 461. The 10-year, that was unchanged at 427. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, JT, thank you very much. We appreciate that. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so head over to youtube.com and search Bloomberg Podcast. A lot of folks are getting concerned about this marketplace, this equity market. It's been higher. There's some valuation concerns. There's headwinds about when or if this Fed is going to cut rates. There's concentration risk, which probably ranks pretty highly with me. Let's check in with a professional and see how they're thinking about it. Shelby McFadden, investment analyst, Motley Fool Asset Management, joining us from Zoom, via Zoom from Alexandria, Virginia. Shelby, how concerned are you about this marketplace? How do you feel about this market? Are you confident that this equity market can continue to move higher? Where are you these days?
You know, I would say the sort of confidence and concern is sort of a two-pronged issue, right? So the confidence, who can say, right? We all kind of wish we had a crystal ball, especially as active managers. But the sort of confidence, I would say, is rooted in the fact that this is the precise sort of market where you can sort of find those opportunities. They may not necessarily pay the dividend right away. And that sort of goes to the issue of concentration that you had mentioned in the introduction, where, you know, we're having to look for those winners, those diamonds in the rough that may not be sort of paying off right now. But when that return of breadth comes back, that's when we sort of get to see the fruits of our labor. That is right there, the crux of active management. So valuations, they're rich. That can be concerning. It's never exciting to have to sit and wait for that golden opportunity that we've been watching out for. But it absolutely pays off in the end, and that's why we stick to that high quality strategy.
Do you care about breadth? Do you care about the 1,700 stats that I read today about how, you know, the top 7 stocks reported X amount of the gain in the S&P so far this year? I say it glibly because I feel like we've been talking about this for like 9 months. So how much do you care about that now?
I would say that breadth does still matter to us. And I even say that given the fact that we have what are considered more concentrated portfolios. So you may be thinking, how does that even make sense? It makes sense in the concept, or rather in the realm that compared to the S&P, compared to what we consider the broad market, we are more concerned with finding opportunities that are not necessarily just all concentrated in one space. So when we do look at our active ETFs, they're not always going to reflect the main stocks that are moving the market. There are going to be some more sort of niche concepts in there that underlie some of the main processes that keep our economy going. So when we look from a portfolio management perspective, breadth is increasingly important to us.
Shelby, how do you think about earnings season? We're going to kick it off Thursday with some of the airlines, and then, of course, the big banks kicking off on Friday. What are you looking for this quarter?
I would say going into early earnings season, you know, we're not expecting anything too earth-shaking from the big banks. For the most part, they've already gotten all of their shakeouts going. We might hear about a little bit of M&A activity and, you know, mainly following the regionals after the big banks. As we go further into earnings season, I think one of the key things that we're looking out for is going to be back office spend, those sorts of budgets on any sort of CRM technology, advertising, all of those sorts of software platforms that made a lot of revenue in the past couple of years. So we're looking to see where corporate budgets are going, but also in the retail space. How is the consumer holding up? The summer is a little bit more dry in terms of promotional activity around holidays. You've got Memorial Day, 4th, Labor Day. So there's a lot of those really big chunks of weeks where there's not as much promotional activity. And that's where we're going to get a truer sense of how the consumer is doing. So we'll be having a good look out for that sort of Easter to end of Q2 chunk.
For the back of the office spend, are you watching specifically like if that budget grows or just that budget stays versus shrinks, or like where it's going to actually be going and how the money is diverted?
It's a sort of all of the above, right? Because that's all going to tell us a different story. So if it is shrinking, that starts to tell us that potentially companies are in a spot where they're so concerned about their coffers that they are now less concerned about efficiency. We think that's a little bit less likely because when you've got shareholders, you tend to need to focus on efficiency. So we're sort of looking for that stable to growing. For a number of companies, their own sort of projections are depending on a return to growth. So a return of companies' desires to have more efficiency. So I would, if I had to put money on it, I would probably say we're expecting to see on the whole flat to growth in that area.
You know, Shelby, earlier today we were speaking with the head economist at MasterCard to get a sense of kind of how the consumer is. behaving.
Michelle Meyer?
Yes.
Love her.
Yeah, excellent, excellent.
We love you too, Shelby.
And she's saying just the data that they see, the consumer is still spending and the consumer looks pretty healthy. How do you think about it?
You know, it's interesting because some of the recent pieces that I've read have pointed to the fact that there's a big cohort of millennials and young or older rather Gen Z that are coming into the stage of their lives where they have to purchase certain necessities. The amount of money in life that they spend is just growing because it has to. And then when you put on top of that the sort of economy that we're in where things are more inflationary, we know that we're fighting that right now. You smush those two things together and we get a picture that looks like a very healthy consumer on the top, you know, the superficial most level. And as we sort of drill down, we see a sort of obligation to spend. When we look at the fact that retailers of things like shoes are broadly pretty weak right now. And so we think about the fact that people are not wanting to pick up those little things in the store, those little articles of clothing, you know, extra pairs of socks, things like that you used to kind of use to comfort yourself. You drill down to that, you realize a lot of the spending is not so discretionary. And so it's healthy in the sense that money is being spent. But the discretionary spend, not as much. So I think we have to really drill down to see what the consumer's feeling.
How do you play it?
I think the way to play it is, one, as you mentioned, there's a way to play it with MasterCard, which is they're a toll taker. So you go ahead and just frankly take advantage of the fact that cars are going to be swiped. Another way to play it is taking the premium end of the consumer. So when we think about companies like Costco, they're offering value, but they're offering really sticky value in the way that they're a little bit higher on the income schedule. Another way to play it is Amazon. You look at the fact that they are retail, they've got a strong retail base, and then they've also got their AWS space. So they really rooted themselves pretty deeply in convenience for both corporate and consumer. So I think it really comes down to, one, companies that have deeply rooted themselves across the cycle, and two, premiumization, and three, toll takers.
So I see on your list you've got Costco there. So that kind of, to me, says you have, you know, kind of a fairly constructive call on the consumer. What's the feeling behind your Costco name?
Well, one of the things we love about the Costco business and why it's in TMFC and a number of our portfolios is that they really generate a sort of annuity type structure. Their primary earnings are really, or their most stable earnings, I should say, are coming from those memberships. And they've really figured out a perfect timing on those membership increases in such a way that it's almost gentle to the customer. They've established a relationship, and so when it comes, people aren't really, you know, running for the fences. And then on top of that, they've got the best cost position in the industry. So we have actually seen over the past 18 months or so, when we listen in for the calls, they lower prices when they can. And I'll even say anecdotally, when I go to Costco, I have pointed out to my husband and said, that's lower than it was a quarter ago. So they are holding up on those promises, and being able to do that is really, really important. And being able to capture the consumer who can afford that executive membership further solidifies their place in their peer market.
You also like Amazon, but that's less of a retail play, right? That's more of a cloud play?
A bit, yes. So we do know that they've sort of solidified that position in retail, but the cloud play is right now, in terms of valuation, of course, what's really most sensitive for them. And that's also where, at this point, our thesis is sort of tipping towards. So the additional growth that we are hinging any sort of investment on for Amazon comes from the cloud space rather than retail. And so that's what we're predominantly looking out for. We're looking for operational leverage there, as well as continuing to solidify their reputation and continue with innovation. So you know, retail is always going to be a little bit wobbly in terms of, you know, any sort of regulations that are coming, things like that. But on the whole, it does seem like the balance between what they do for the consumer and their competitive position seems to be sort of leveling out. So really the thesis hinges on AWS.
Hey, Shelby, who is a typical investor or customer of Motley Fool Asset Management?
Yeah, I would say a typical investor would be someone that is looking to access high growth names in, of course, you know, global, but primarily U.S. markets, but looking to do so by stepping outside of the concentration of the U.S. market. So even though the portfolio itself, an average portfolio for us is going to be 15 to 30 stocks, it's someone who's looking to beat the market over the long term, over 10 to 15 years, go ahead and build that wealth. by making choices outside of the sort of status quo. And that doesn't necessarily mean that we're just choosing really, really niche sectors that no one's heard of, but we are looking for those high quality companies that are going to focus on cash flow and be a bit more resilient to the cycle, and therefore deliver, focusing really on upside capture especially.
So then to that point, do you not care who wins the White House in November? Like that could definitely influence policy, particularly when it comes to climate and environmental laws. But in general, are you able to look through that, or how do you manage it?
I would say in the short term, it's not something that we're integrating into our strategy because it's not something that we have control over. In the long-term view, we understand that there could be some sweeping changes. But we do also know that that legislature will take some time. So we keep our monitors out. We have our various lists and various contacts that we are, in touch with, calls that we will tune into, so that we can be on top of things to adjust our models appropriately. So I would say that in terms of our strategy, we have to sort of be a bit agnostic. I don't know that I would say we can care, because that may do a disservice to our investors to say it has to be this for us to succeed. We are determined to make sure that we adjust accordingly with any regulations or policies that change to make sure that we can serve the active investor as best we can.
All right, Shelby, thank you so much for joining us. Shelby McFadden, she's an investment analyst at Motley Fool Asset Management, joining us from Alexandria, Virginia via Zoom. Alex, I'm looking at WTI crude oil. It's off about 0.5% today, but still, just under $83 per barrel. I'm paying $3.50. That's the national average for gasoline, although I fill up at $3.37 this weekend.
And how many gallons does the new Vespa
The new
take?
Vespa, it takes 2 gallons, and I'll go darn near 200 miles on that 2 gallons. So
amazing. Did you already talk about the Vespa on radio?
Just in surveillance.
Okay. So Paul got a Vespa. It's a nice light blue color.
Yeah.
It's a beautiful piece of machinery.
Yes,
He's
and
gonna
so
be
that was a
riding around in
midlife
Jersey.
crisis purchase, to say the least.
If
but
you
that's
see
fine.
him at the shore,
Yep.
Stay clear.
He's the guy in the blue Vespa. But interestingly, we have hurricane or tropical storm Beryl hitting Texas, and we're not really seeing any reaction in the overall crude market, which is quite interesting. I was talking to Chuck Watson of Enkey. He does a lot of disaster modeling and stuff, and he was saying that, look, in essence, these companies, whether you're refiners or whether you're an export terminal or whether you have a big platform in the middle of the Gulf of Mexico, like, you're kind of used to this. And after Hurricane Katrina 20 years ago, everyone kind of upgraded their stuff. So unless something literally breaks, then they should be able to resume. So it's a different world now when it comes to storms. In essence,
I can't imagine being on a rig out in the middle of the Gulf during a big storm.
Well, presumably they're evacuated.
They're evacuated, so you take them off.
Yeah, that's the other problem, though, is how quickly they can come back, and then that sort of might hinder any kind of output, but that's different than a complete catastrophe at the end of the day.
Okay, because that's hitting right in that area of Texas that has all that stuff.
It's the refiners and Freeport export facility for LNG. Those are the two big ones.
Yeah, big one. I will keep an eye on that. Looking at the markets here real quick, S&P 500 up 6 points, the Dow up 140 points. That's about 0.3%. The Nasdaq's up about 24 points. That's 0.1%. Yields steady. 10-year Treasury 4.28%. With our news in New York City, here's Michael Barr.
Thank you very much, Paul. Alex, John, President Joe Biden pledged to follow Democrats, and then he will remain in the 2024 presidential race. He's seeking to quell an intra-party revolt against his campaign. In a letter to Democratic lawmakers released by his campaign, Biden said, quote, "I am firmly committed to staying in this race, to running this race to the end and beating Donald Trump." Terry Haynes, founder of Pangea Policy, said the president delivered the same message in a TV interview Friday night.
He still knows how to give the middle finger to people, and he did that with some force on Friday night because he gave the middle finger to the Democratic donor class and a lot of the political class that all of a sudden decided he's not up to it.
Terry Haynes of Pangea Policy. The letter comes as lawmakers return to Washington from a holiday recess for the first time since his debate performance that set off a panic about his mental acuity and ability to defeat Trump in November. Over the weekend, some prominent House Democrats said privately they want Biden to step aside. Beryl has made landfall on the middle Texas coast near Matagorda with a dangerous storm surge and strong winds. The storm center hit land as a Cat 1 hurricane around 4 a.m. today, about 85 miles southwest of Houston, with top sustained winds of just under 80 miles an hour. Harris County Judge Lena Hidalgo.
No matter where you are in Harris County and in our region, we need you to prepare and we need you to be ready for the next 24 hours.
Harris County Judge Lena Hidalgo, as more than 1 million customers are without power. Officials in Ukraine say a major Russian missile attack has killed at least 28 people and injured almost 100.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages, they are higher right now, but have paired some of the earlier gains. S&P 500 and the NASDAQ, they were hovering right around records that they set last week. Jerome Powell delivering his semi-annual testimony to Congress. That starts tomorrow, and we're looking for signs of more dovish tilt. Thursday, we're going to get the latest inflation read with the Consumer Price Index. A Fed rate cut may only be a few months away, at least that's according to Jeffrey Yu at the Bank of New York Mellon.
The Fed, like most central banks globally, have said they don't need to wait for inflation to seriously undershoot targets before acting. So I think that's where we are right now, and markets are pricing in on course for a September move.
Right now, the best performing stock in the S&P 500, that belongs to the glassware maker Corning after their core sales beat estimates. NVIDIA's target raised at UBS. They cited exceedingly robust demand. Shares of NVIDIA right now, they are up just over 2%. And Eli Lilly agreeing to buy the U.S. gut drug maker Morphic Holding. The price tag there, $3.2 billion. As a result, Morphic Holding shares, they are up 75%. Overall, S&P 500, 5 points higher, 55.72 on the index. Dow Jones Industrial Average up 150 points. And the NASDAQ right now is up 10 points, a rise of just under 0.1%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news from business, economics, and finance through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. This Monday, though, we're going to go outside the Bloomberg Intelligence world and take a look at what's going on with ETFs. Joining us now is Sean O'Hara, president of Pacer ETFs, has $45 billion assets under management. He joins us from Pennsylvania. So, Sean, we love this topic. Like, who's buying what? Where are the flows? Where are they coming out of? We just ended the second quarter. We're kind of kicking off the back half of the year. What's the setup?
Well, it's the same setup as it's been for the last 6 months. The 7 stocks are really responsible for all of the performance. So I just read a